Hello everyone, this is the third part of a series regarding self-directed IRA investments and what investors are really putting their money into, what values they're assigning, and where they're doing their investments. And we've been doing this out of a report recently published by Equity Trust. Some of you know that company. You can look on the web for them as a company. They're a third-party administrator. I'm not plugging them necessarily, but it's just some information they provided, and I thought it was very interesting to see what's really happening, because investors always want to know, well, am I doing the right thing? What are other people doing? Am I going to the right places, the right states, and everything like that? So as we've seen, Indiana and Florida, top states for investor money, top states for out-of-state investors coming in and putting money in. This video is going to talk more about note investing. So a lot of investors buy real estate, a lot of them just buy the paper, right? So when we talk about paper, we mean they're buying trust deeds or promissory notes and mortgages secured by real estate. And this graphic is very interesting. I'm going to put it up right now, right? And then I'm going to summarize for you all the information in there real quickly. And what it does in the top half, it breaks down, first of all, what's the overall normal average note that's being bought. And in the market last year, 2018, the average note was 80,000. So go through everything. The average note was bought for 80,000. So if you're in that market, or you're an owner that's got property and you want to create a note against it, that's the average, so you know what's available in the marketplace. What we see in that first part of the graphic is that there are lots of notes, and they break them down by value: 25 to 50, or under 25, 25 to 50, 50 to 100, 100 to 250, over 250. And there's really a nice balance between all those different valuations until you hit 250, and then it kind of goes off a cliff, and there's only 3% of the notes being bought are in that valuation. Everything else, a nice stratification of values of notes being bought. Again, the average being 80,000, but plenty of activity, plenty of money available for you as a borrower or a note seller if you're trying to create some liquidity in all those areas. What the next part of it talks about, the next stratification, is what maturities, are available. And under 2 years, there's not a lot of activity. So if your note is already matured out and you've only got a year or 2 years left, there's not a lot of activity there, unless there's a high rate of interest. If it's over 10%, then you can get a little bit more activity. But otherwise, it looks like note buyers and note investors seem to be looking for longer terms. And once we go over 2 years of maturity, they also, of course, there's more money invested at the higher interest rates, but you got to at least get to 2 years, or there's, they don't want to mess with the money. A lot of investment at 7 to 10%, right? So that was 34% of the market. Over 10% was 50% of the market. Under that, the low values are a lot less, 2% and 4% going into it at the 5% and lower interest rates. So looks like note investors want to get a decent return on their money, 5 to 7% at least. 7 to 10%, there's plenty of activity. Over 10%, lots of activity. So that just, risk and reward goes together. You might also look at this data and ask yourself, what's the relative collateral security, and what's the history of those notes paying off. And if you've got a nice stable note with a good payment history for a year, 2 years, and then you've got a nice long tail on it, then you're going to be able to find a replacement buyer for that note. Lots of neat information, but that gives you some good anecdotal, solid data, what happened last year, what real investors with real money were doing with their investments, and the kind of returns they expected. So now you've got more information. Hope it helps you. Have a great day.